My name is Michael Mauboussin. I work at BlueMountain Capital, and here we're talking about behavioral mistakes in valuation and behavioral mistakes in general. If you think about where you can gain advantage in markets, it tends to be gaining some sort of informational edge, which has become increasingly difficult, having some sort of analytical advantage, which is really hard. But the big one is really behavioral. And what we know is most inefficiencies that come from market, or many inefficiencies that come from market, are often from behavioral failures. So it's, I think, probably, if not the largest, certainly one of the largest sources of opportunities and one of the largest sources of failures. First is, it is really important to try to minimize your own mistakes, and that is typically trying to identify what kinds of biases you're likely to have or what kinds of mistakes you're likely to make, and then to try to minimize those as well as possible. And the second is, of course, if other people are going to make those mistakes, those will present opportunities, and you don't want to be shy to try to take advantage of those. I'll tell you one interesting side story on this. There was a really great interview with Atul Gawande, who's a surgeon up in Boston, and he told of a paper he read about mistakes that doctors make, so physicians make. And we'll bring this back to investing in a second. And he said there are basically two different categories. The first category is called ignorance, right? We just don't know what medicines will make people better, or we don't know how to do a particular surgery. And of course, reducing that ignorance is great, and that's what a lot of billions of dollars in R&D go to do. But the second kind of mistake, which is probably more prevalent and probably even more costly, is that people don't do what they know they're supposed to do. So physicians may not wash their hands or do certain protocols before surgeries or whatever it is. And that's much more pedestrian, and the doctors know how to do it, they just don't always do it. And I think the same kind of thing applies in investing. A lot of it is just doing the things that we know that we're supposed to do, thinking about all the different outcomes, weighing things intelligently, and again, trying to be aware of and to manage and to mitigate all those biases. So I think they're both sets of opportunities, reducing errors, finding other people's errors, but you have to think about it both ways. So the first mistake is a failure to use base rates. And I really think this lesson I got from Danny Kahneman, of course, very famous psychologist who won the Nobel Prize in economics. And here's the basic setup. There's this idea called the inside view and the outside view, which is base rates. The inside view says, when I'm posed with a problem, it can be almost any kind of problem, the classic way to deal with it, and see if this makes sense to you, right, is to gather lots of information, combine it with your own inputs and experience, and then project into the future. So for example, if I say, analyze this company, you'll gather lots of information, you'll build a model based on your inputs and your experience, and that'll reveal what you think is going to happen. The outside view, by contrast, which relies on base rate, says, I'm going to think about my problem as an instance of a larger reference class. I'm going to ask the question, what happened when other people were in this situation? Or if you're modeling a company, what happened when other companies were in this situation before? And I want to underscore it's a very unnatural way to think for a couple of reasons. First is you have to leave aside all this cherished information, right? Your own experience, which we tend to place a lot of value on. And second is you have to find an appeal to this base rate, which may not be at your fingertips. Let me give you one example to try to make this slightly more concrete. About a year ago, a little less than a year ago, The Economist had a cover story on Amazon.com, right? This company is really doing great, taking over the world. And in there, one of the analysts said, we think that Amazon will grow revenues 15% a year, compounded annually for the next 10 years. Now, at the time, they'd had revenues already over $100 billion. Now, I'm sure that analyst, if you sat down with him or her, would have this awesome model going through all the different businesses and a very convincing overall narrative. But the question that the outside view would ask, or the base rates would ask, is how many companies have ever grown at that rate of that size in history? And the answer is, it's never been done, at least not since 1950. We look at all the companies back to 1950, inflation adjust their initial revenues, and look at their growth rates. Never been done. Might Amazon do it? Absolutely, right? But now, given the fact that no one's ever done it before, the question is, what probability would you be willing to assign it? So it's, right, it introduces a different way of thinking about things, I think a way that's fairly well grounded. It helps people think, I think, much more analytically and in a much more robust way. The second big mistake is a failure to understand regression toward the mean. And let me start with a little bit of a framework that helped to think about this, and it makes tons of intuitive sense once I explain it. You could think about a set of activities in life on a continuum. On one side is things that are all luck, no skill. So you think about roulette wheels or lotteries, that type of thing. And on the far extreme, other extreme, is all skill, no luck. So you think maybe like running races or chess, where luck just doesn't really play a big role. And almost everything in life, as you might imagine, is somewhere between these extremes. Well, it turns out if your activity is close to the luck side of this continuum, there is really, really rapid regression toward the mean, and I'll define it in just a second. And if there's all skill, there's very little regression toward the mean. So that's a really interesting heuristic. Now, what does regression to the mean say? It says that outcomes that are far from average will be followed by outcomes with an expected value closer to the average, right? Far from average, expected value close to the average. So it means that things are going to become more average over time. So when we say failure to understand regression toward the mean, again, it goes back to how do people model things? They typically think to themselves, I've built my model, I have a view of the world, and they don't take into consideration where these different things are on the luck scale continuum and how rapidly they'll regress toward the mean. Now, what's really interesting is if you go through a financial statement, for example, sales growth rates or margins or earnings growth rates, we can actually figure out where they lie on this luck scale continuum or how persistent they are. And it turns out some items are very close to the skill side or very persistent. That would include things like gross profitability, which is gross profits divided by assets, or operating margins. And other things are much closer to the luck side or much more random. And that would include things like sales growth rates and even earnings growth rates. So when you're going through building a model, it's really helpful to understand which items are more likely to be susceptible to regression toward the mean. And that'll be a much more thoughtful way to model. Almost very few analysts think about this in any sort of systematic and rigorous fashion as they're doing their bottoms-up models. The third big problem is overconfidence. And if you said to me, by the way, of all the behavioral biases that afflict investors, probably the two big ones I would talk about are overconfidence and we'll call confirmation bias. And here's the basic idea. Overconfidence says you're going to think that you understand the future much greater accuracy than you actually do. So what that typically says is people model future outcomes that are vastly too narrow. Now, there are lots of ways we can demonstrate this. For example, you ask people a series of questions, things that are kind of random. How long is the River Nile? How old was Martin Luther King when he died? And these kinds of things. You say, tell us what you think the answer is, and then give a range, high, low, within which you're 90% sure the true answer lies, right? So in theory, at least, if you're doing this accurately, you should get 9 out of 10 right within your bands. If you do this experiment with people consistently, the answer is something more like, 5 or 6 right. They're usually 50% correct. So people tend to think they understand the future better than they actually do. So when you're thinking about modeling businesses, or really modeling anything, it's really important to take into consideration the full possibilities of outcomes. And overconfidence tends to prevent us from doing that effectively. Well, the fourth big problem is relying too much on multiples. And I guess I would start with a very important underlying point, which is multiples are actually not valuation. Multiples are a shorthand for a valuation process. And shorthands are great in life. They save us a lot of time, but they also come with blind spots, and it's really super important to be aware of those kinds of things. So what underlies a multiple, or what is valuation ultimately about? Well, valuation is the present value of future cash flows, whether you're looking at a stock or looking at a bond or basically real estate or basically anything. So the key consideration that I'd like to introduce in this is understanding the role of return on invested capital. And here's the basic intuition. If you make investments in the market that earn a return on invested capital exactly equal to the opportunity cost of capital, right? So I demand 10% and I earn 10%, you don't deserve any sort of high valuation for that, right? You're basically your dollar's worth $1 in the marketplace. By contrast, if you take $1 and it earns a 20% return versus a 10% opportunity cost, that's awesome, right? And the more you grow that thing, the more valuable the entity will be, and the valuation should be justifiably high. Third and finally, if you take that dollar and invested 5% return when the demanded return is 10%, you're actually destroying value. By the way, you may be growing earnings, but you're destroying value. So the key is that ultimately multiples hinge on two really important dimensions. The first is the return on capital, cost of capital spread, and you need to understand that and be super explicit about figuring that out both today and prospectively. And second, and only second, is growth. And growth tends to amplify. So if you have high returns, growth is really, really good, and the more of it you have, the better. And if returns are bad, growth actually amplifies a negative. The faster you'll spin out of control. So the key is when thinking about valuation and multiples is to understand where they're useful, but also understand the implicit limitations, of which there are many. The fifth mistake is a failure to compare effectively. And by the way, the topic of comparison is absolutely fascinating. It's been a big area of study in cognitive psychology. The typical way we compare things is by analogy. So you say, is this like that? And while analogy can be useful, there tend to be two types of common mistakes. The first is one about breadth, and the other one's about depth. So what's this breadth problem? The answer is, if you're coming up with an analogy, you're probably scanning your memory for something, and while your memory may be very good, it's probably finite, and you may not come up with the appropriate analogy given what you're thinking about. So there is a breadth problem. Depth is, now you've found an analogy, it's actually pretty good, but you're looking at features of that analogy that may be somewhat superficial. More formally, it might be correlated but not causal, and as a consequence, you're coming to faulty conclusions. Now, what does all this have to do with investing? Sort of the classic way that investors and even investment bankers compare companies is they'll say, here's my focal company, and then here are a list of comparable companies, often in the same industry, by the way. And this will be shocking to hear. If you look at the academic research, it turns out that analysts often will find companies, these comparable companies, that make their case look good, right? So if they're trying to prove that it's a cheap company, they'll find a bunch of expensive companies, and it'll help their case. Another way to do this is something called similarity scores, and say, rather than looking at companies in the same industry, or of course, sort of biasing that sample, let's take a look at, cast a very wide net, look at all different kinds of companies and see which companies have features that are more common or common with our focal company. And that allows us to understand not only companies within the industry that are similar to our focal company, but also companies outside the industry. And it turns out that's a much more robust way to think about company comparison. By the way, these kinds of techniques, these similarity techniques, are used all the time. It's actually a technique in machine learning. But even if you go to things like Amazon or Netflix and they recommend a movie or a book to you, they're using some variation of this type of a similarity score. So this is a common mistake, is we tend to be very simplistic about making these comparisons, when right at our fingertips there are methods that are vastly more robust and I think more instructive. I think the one that's the biggest one is ultimately base rates, the very first one. And it's an interesting question. If you said to me, what do I wish I had known, years and years ago when I was starting in the investment business, I think that would be the one that I would probably talk about. And by the way, base rates are not just relevant for the world of investing, but pretty much anything you think about in life, almost every experience that you have, or if you like sports and you're a sports fan, these are all, these concepts permeate everything. It's thinking about what are the prior experiences of others, and how might that or should that bear on my prospects? And I think it's just an incredibly powerful mental model, vastly underutilized, but again, for two very good reasons. First is we probably don't have the numbers or experiences at our fingertips, so we don't have that catalog. And second is we tend to place too much emphasis, we rely too much on our own experiences, our own senses, our own inputs, and as a consequence, we tend to underweight the experience of others. The interesting thing about base rates and regression toward the mean is those two things, those two ideas actually can work in a somewhat of a package. So if you understand base rates and you understand how some of these factors unfold, it gives you insight into both prior experience and also to the rate of regression toward the mean. So that's a really, just if you start to delve into that world, understand base rates and understand how those tie back to regression toward the mean, that's very, very powerful. Things like comparing, it would be to embrace as soon as possible some sort of similarity score, some sort of open, more open way of thinking about comparing things, and being very mindful that selecting just small sample of comparable companies or other examples is going to be very limited in your thinking. Overconfidence is a really interesting one, and often the best thing to do is pull in a friend, loved one, or even colleagues to say, here's how I see the future unfolding. Are there things that I'm not considering? And so you really want to open up your mind to make sure that you're considering all the possibilities. Often groups can help you do that. There are specific techniques like red team, blue team. So you're making a case. You're the blue team. I might come in as the red team. I'm the devil's advocate. I might say, hey, did you think about this or that? And that, again, has this idea of opening up, or tries to open up your mind to what's going on. So for each of these things we've talked about, there are very specific techniques that you can use. But the key is to weave those into your process, right? Really to have them embedded in what you're doing to try to get you down the right path. Where can we take advantage of other people? There are a couple categories that I would probably touch on. The first is something that's very well documented in the academic literature, is that institutions or professionals tend to benefit at the expense of individuals. And so whenever you see individuals start to flock into, whether it's an asset class or whatever it is, there often can be the case that institutions can take advantage of that on the other side. One of the most recent, very well documented examples of that was the dot-com phenomenon in the late 1990s. Individual investors had actually been stepping out of the market directly. They've been giving more of their money to money managers and so forth. But in the late 1990s, with all the excitement around the dot-com, they started putting their own money back in a big way. And that really led to lots of mispricings and ultimately opportunities for institutional investors. Another example is, I would call people who buy or sell for non-fundamental reasons. And there can be cases that people have to sell. One example is something called the leverage cycle, where someone buys a lot of an asset, having borrowed, and then if the asset starts to go down, they get things like margin calls, so they have to put up more capital, which means they have to sell the asset. So they're selling not because they think it's overvalued, but selling because they have to. So sometimes being on the other side of that trade can be helpful. There's another even more prosaic example, that is spin-offs. This literature on spin-offs has been around for 30 plus years, and it turns out that companies that spin off businesses, what happens is you're a large money manager, it's this tiny little thing, it doesn't really fit your mandate, and you just basically sell it without asking any questions. And by the way, which may be perfectly rational, and that often presents opportunities for people on the other side. But maybe the biggest one, the big daddy of these things, is what I call taking advantage of diversity breakdowns. And so if you look at the literature on the wisdom of crowds, basically crowds tend to be wise, and we think about markets. Crowds tend to be wise when three conditions are in place. One is they're diverse. Second is there's a properly functioning aggregation mechanism, so the views of people are being reflected, and markets do that really well. And then third, there are incentives that are operating effectively. And you say, when does the madness of crowds take over? And the answer is when one or more of these conditions are violated. And by far the most likely to be violated is diversity. So rather than us thinking differently or independently, we correlate our views. So it's a very interesting set of questions about, when you look at different, whether it's asset classes or particular stocks, is how diverse are the views of those people who are investing. And if they're all very aligned, whether bullish or bearish, that often represents an opportunity on the other side. Now, what's interesting is if everybody believes one thing or another, psychologically, you're going to be drawn to believing the same thing as everybody else, right? So it's psychologically extremely difficult to be a seller of dot-com stocks in March of 2000. It's extremely difficult to be a bull on the market in March of 2009 psychologically, but of course, those are the sort of great moments to do that. So I want to say that it's easy to say, but very difficult emotionally and psychologically to actually execute. How people make mistakes probably does change throughout a cycle. And you think about it, is probably early on is people are too fearful. And at the end, they're probably too bullish, right? They don't have enough specific fear. So there's a really fascinating experiment by the psychologist Antonio Damasio that pitted normal people against people with brain damage. Now, the brain damage here was actually very specific. It turns out these people could do all their calculations correctly, like math was fine, but what was damaged was their emotional seat, so their ability to feel fear, greed, anguish, those kinds of things. So they're kind of emotionally flatlined. And here is the setup of the game. You're endowed with $20, everyone got $20, and you're allowed to play 20 rounds of a game. In each round, you could either hand your dollar over to the researcher, and they would flip a coin, and it was a positive expected value. So the net present value is positive. So on balance, you want to do this. Or you could just sit out the round and keep your dollar and move on to the next round. All right, so that's the basic setup. Play with some positive expectation, although you could lose, or just go on. So again, normal people versus brain damaged people. It turns out the brain damaged people ended up with quite a bit more money than the normal people, which was interesting. So why is that? Well, everyone understood at the beginning of the game they should hand their money over to the researchers and have the positive expectation coin toss. But it turns out that the normal people, if they lost a few rounds in a row, said, oh, that's not for me. Let me just sit out a few rounds. I'll just keep my dollar, and then I'll get back into the game when I'm feeling a little bit more emotionally settled. The brain damaged people, by contrast, knew the math, didn't feel the feelings, and hence they just kept playing and ended up with more money. And I think that very much speaks to how market cycles work. If you've come off a period of losses, that tends to affect and shade how you make your decisions in the future. By contrast, if you've made a lot of money, very prosperous period, you tend to be more risk-seeking, you tend to put your guard down to some degree, and that will also affect. So I do think that these psychological things are very much influenced based on where we are in the cycle and basically your recent prior experience. I've taught security analysis at Columbia Business School, a finance course, for about 25 years. And interestingly, when I started teaching that course, I really had almost none of this behavioral stuff in there at all. Why? Because the field was really just getting going. It had been around. Kahneman and Tversky did much of their seminal work in the 1970s, but really hadn't permeated into the economics or finance field really until the 80s and 90s, and it was really just getting going. So part of this was just learning and awareness and all these tools and techniques. And second is understanding that there are really two different things that are really important. First is understanding the broad concepts. And that's where Kahneman and Tversky made such important contributions. They call it heuristics and biases. Heuristic means rules of thumb, which we all tend to use to navigate the world, which are very helpful, that lead to specific and predictable biases. So understanding those heuristics and biases is super helpful. But the bigger challenge is, what do you actually do about all it, right? So it's one thing to understand the concepts, things like overconfidence or framing of facts. These are all well understood concepts. The second question is, what do you actually do? So as an organization or even as an individual, you have to start to think about how you can build specific tools and techniques into how you think about things to allow you to manage or mitigate those things. So it's really not just the awareness that helps. It's the tools and techniques. So if you said, how have I tried to evolve over the last 10, 15 years? It's really to be much more concrete about the methods to offset these biases, not just being aware that they exist. I'll tell you, there's a really interesting technique that anybody can do that is very humbling if you do it. And I did this and it was very humbling to me. And that is to keep some sort of a decision journal. And now, ultimately, a decision journal is, you write down what you believe, why you make a certain decision, and you write the date and time, and you just document your thought process. And that allows you to go back and audit your thought process. And I think if you do that, sometimes, for example, an investment may turn out well, and you realize that your thinking behind it was all wrong. So in a sense, you can't give yourself too many points on that. But for a while, I was keeping a journal, and I was not only writing down the decisions I was making, but I was also just writing down my observations about the world. And, sort of I would read an article and say, hey, I have a reaction. I'd write down some thought about that. And when I went back and reviewed that, I just realized that in many cases, I was like laughably wrong about things, just woefully inadequate. And part of that is that I was tended to extrapolate probably much more. So for me, that was probably the big thing, is I tended to think that trends that were going would go on more than they would. Now, I have to say that in my day-to-day life now, I pretty much have shunned all forecasts. So I try not to go into the forecasting business. I really do try to understand my limitations. When I think about the world, I try to be, I call it macro aware, but macro agnostic. So I try to be aware of what's going on in the world, understand how those things in the world might affect what I'm doing, but be very agnostic about the outcomes, because I really do realize massive limitations in my ability to forecast the future. So I think that's the one that, for me, that's been a very humbling exercise, is just to write down some thoughts that I have, to codify it, and just when I reflect back and do an audit of my own thought processes, to recognize how limited I really was in my perceptions.